There's a strange thing happening in global energy markets right now. While everyone's talking about renewables, EVs, and a carbon-free future, the fuel that built the modern world keeps breaking demand records. Oil and gas, written off by most of the investing world, are suddenly defying the narrative. And that's what we do here on this channel. We look behind the headlines, dig into real fundamentals, and follow where value is hiding, not where the hype is pointing. If you've been following my copper and uranium theses, you already know the story. Underinvestment creates opportunity. The same pattern now seems to be unfolding in oil and natural gas, only this time the scale might be even bigger. So let's break down why the world's most unpopular sector might quietly be setting up for one of the strongest commodity bull markets of the next decade. You can trace this story back to 2014, the year oil crashed. That collapse changed everything. Projects were canceled, budgets gutted, and for the first time in years, the industry shifted from growth to survival mode. Instead of pumping at all costs, producers began paying down debt, rewarding shareholders, and promising capital discipline. It sounded good, finally responsible management after years of reckless growth. But there's a catch. Oil fields decline naturally by about 5% per year. Without reinvestment, output quietly erodes beneath the surface. Fast forward nearly 10 years, and upstream spending is still far below what's needed to replace global depletion. The industry didn't just pause, it lost an entire generation of projects. That's why even with healthy prices, new supply can't appear overnight. The pipelines are half empty, both literally and figuratively. Now here's the twist. While supply has stayed cautious, demand has done the opposite. Global consumption of oil and gas hit record highs in both 2024 and 2025. That's not coming from Europe or North America. It's from emerging economies like India, China, and Indonesia. Billions of people are still climbing into the middle class, flying for the first time, using air conditioning, driving cars, and consuming more power. It's easy to forecast the end of fossil fuels from a high-rise in London, but on the ground in South Asia or Latin America, energy demand is still booming. Even natural gas, once dismissed as a bridge fuel, has become the backbone of modern grids. When the wind doesn't blow and the sun doesn't shine, gas turbines keep the lights on. Europe learned that lesson the hard way. The world isn't anywhere near ready to replace oil and gas. Not yet, and not entirely. If you overlay the two trends, underinvestment in supply and resilient demand, you get one clear picture: structural tightness. This isn't short-term volatility, it's the product of a broken investment cycle. OPEC Plus has limited spare capacity. US shale, the miracle that saved the last decade, is slowing as core wells deplete. Political pressure and ESG mandates have choked off financing for new exploration. Discoveries of major fields near record lows. The result is a market that can no longer respond quickly to price signals. Even at $90 or $100 oil, producers won't flood the market the way they used to. They're leaner, more cautious, and far more focused on balance sheets than barrels. Ironically, that discipline, born out of fear, might be the very thing that drives prices higher for longer. To be fair, the opposing argument says that renewables, efficiency, and electric vehicles will soon crush oil demand. And on paper, that sounds inevitable. But energy transitions don't move on paper, they move in decades. Every EV battery, solar panel, and wind turbine still depends on hydrocarbons through mining, refining, transport, and manufacturing. Even clean tech is built on oil. The International Energy Agency, once sure that oil demand would peak by mid-decade, keeps pushing that date further out. Yes, one day fossil fuels will decline, but before that happens, we may go through several years where supply stays tight and prices stay elevated. That's how cycles work. You get shortages, investment returns, prices rise, and only then does supply finally catch up. We're not even in the middle of that process yet. This isn't the wild shale boom of old. Companies aren't chasing barrels for the sake of growth. The new era of oil and gas is about cash flow, not production. Producers are optimizing instead of expanding, which turns even moderate prices into huge financial returns. Balance sheets are strong, debt is low, and shareholders are being rewarded through buybacks and dividends. It's a rare moment when the most unloved sector in the market is also one of the most financially disciplined. That's what makes the setup so fascinating. It's not speculative, it's structural. As always, none of this is financial advice, but if you're studying the sector, there are a few general ways people often position for such cycles. Some prefer the big integrated majors like ExxonMobil, Chevron, or Shell, stable cash machines that benefit from sustained high prices. Others look at smaller, pure-play producers with more torque to commodity moves. And then there are the service and drilling firms like Schlumberger or Transocean, companies that benefit when producers start reinvesting again. For broader diversification, energy ETFs can track the entire sector for those who don't want to pick winners. However you look at it, the key theme is the same. The world still runs on energy density, and no alternative has replaced oil and gas yet. The world is trying to build a cleaner future, and that's a good thing. But like any grand transition, it's messy, expensive, and slow. Between now and that future lies a period where traditional energy remains absolutely vital. After a decade of neglect, the sector is lean, disciplined, and ready. The setup is simple: low investment, strong demand, limited spare capacity. And that's the kind of equation that usually leads to bull markets, whether people see it coming or not. As investors, analysts, or just observers of the global economy, the lesson here is universal. When the crowd loses interest, opportunity often hides in plain sight. If you enjoyed this breakdown and want to stay ahead of major commodity cycles, from energy to metals and beyond, make sure you hit that like button and subscribe. We dive deep into the fundamentals that others overlook, cutting through headlines to find the long-term opportunities shaping the macro landscape. Tell me in the comments, do you think oil and gas are entering a new supercycle, or do you believe the world's finally ready to move past them? I read every comment, and your thoughts often shape future videos. Thanks for watching, and I'll see you next time, where we uncover the next sector quietly building momentum beneath the surface.